Morning everyone, thank you Debbie. Just to let you know that we are going to try and get some audience participation today. You'll see on your seats or on your tables some cards. We're going for the active route rather than the push the button route, so there we go. Okay, we're going to have a look at the key risks and managing the key risks of financial wellbeing this morning, and Simon and I are going to double act it. We know there's a whole body of research, you'll have seen research from lots of different sources that link the fact that poor financial well-being isn't just poor for the individuals concerned, but it also impacts business, it impacts productivity, it impacts engagement, it impacts retention, acquisition, etc. So it's something that businesses need to invest in. Just how big a problem is it? We did some work, CIPD did some research at the beginning of the year, and what they found was it affects 25% of employees. Now, it isn't just affecting those, it's affecting them to the extent that it impacts their ability to do their job properly. So a quarter of all your workforce is impacted by this. That goes up to around a third when you look at younger employees or people living in London. It even affects people who are actually on high base salaries, so people who are on 45 to almost 60,000. 1 in 5 of those are impacted at work because of financial worries. Even the highest paid, people earning above £60,000, 1 in 7 of those are worried about money to the extent it affects their ability to do their job. So just looking at those numbers, I know a lot of you, segmentation is a big word, segmenting your workforce, but it's going to affect a lot of your workforce if you look at that. So who needs help? Who needs help? I think when people think about financial well-being, they immediately think about debt. But actually, every single one of us in this room, I'm sure, has worried about money at some point in our lives. There are pinch points, there are times when money gets more on the agenda, and we've just put some examples up there. People going through divorce, people approaching retirement, even those people who perhaps have reached their annual allowance limits, they're worrying because they think, well, where do I now put the other money that I was putting into my pension? You know, people who are looking after relatives in care, there's lots of reasons why people worry about money. So how do we solve it? And we want to try and give you some real practical help today. The answer really is full financial education plus access to advice and implementation. For somebody to improve their financial well-being, just knowing, raised awareness is not enough. They actually have to do something. They have to act. They have to take action. Otherwise, improvement's not going to happen. So that's nirvana. That's the perfect scenario. That's best practice. But recognizing actually that not everybody can start there, and even if you have started there, it's a journey to get there. What are the starting points? So the starting points really need to be to look at the areas where you're going to create the biggest impact, and then the areas where you're going to have the biggest risks. And today we're talking about the areas of biggest risk. There are 4 areas of risk, and we're going to look at those in turn today, and Simon and I are going to look at them together, and Simon's going to illustrate the problem, and I'm going to look at how that can be solved really. And you look at these areas, and these areas are a problem because they're happening now. They're happening every single day. And if these aren't fixed, people will, it's not might, it's will. They will be making bad decisions, which are going to put them in a worse position. And for some people, like for example DB transfers and those at retirement, if they make bad decisions then, they can't be rectified. So these are the biggest risk areas. And so Simon's going to talk about the first one of those in the at retirement space.
Thank you, Jeanette. Well, let's take a few moments actually looking at some of the key considerations at the point of retirement. And we've got 4 that I've put up here. My challenge, though, is why do people still think that it's a tick box exercise? We're still seeing too many people approaching this, partly due to the mountains of paperwork that people receive from their various pension providers and in general at retirement. So perhaps let's look at some of these things in a bit more detail. So, everyone's got these cards in front of them at the moment? Okay. I've got some figures here on the screen. What income do you want in retirement? Let's have a show of hands, show of our cards. A, B, C or D. What do we think people want in retirement?
There's a lot of Ds. There's a lot of Ds.
So we've got predominantly Ds in the room. That's blue for everyone. Before we consider this answer, I'm still absolutely amazed by the number of people that don't know what they need themselves, but are prepared to complete the paperwork that comes at the point of retirement. So they make the decisions first without really understanding what the answer may well be. Based on some research carried out by Which at the beginning of this year, £26,000 per annum is the average amount of income a couple needs at the point of retirement. So that's certainly a lot less than what people put up in there in the room with the various cards that you put. So that may come a surprise about what the average need is. How do we get there is a big question, of course. If we take 2 state pensions, that gives us just over £12,000 of income a year, but potentially there's still a shortfall of just less than £15,000 a year at the point of retirement. Now, assuming that individuals don't want to retire at state pension age, actually the shortfall in early years or early part of retirement may actually be significantly greater than this. My concern, though, is a lot of people don't know this until the last few months prior to retirement. So, when do we want our income to stop?
Let's see your cards.
Come on, cards up. Wake up, everyone, please.
A bit more mixed, actually, but D is don't know, or possibly more than what's there.
Yeah.
But some
absolutely. I think we certainly need to take our own health and well-being and our family history into consideration. Let's face it, one thing that we certainly know for sure is that your need for retirement income will not be a linear throughout retirement, and that's something that a lot of people don't really understand and grasp. So for now, what I will do is we'll consider 95. I think let's be prudent. Let's consider 95 rather than I don't know when. So we've got an income shortfall of about £15,000 a year. We need that income to last us till about 95. How much capital do we think we might need to support that requirement until the age of 95? So I think we're used to this by now. Hands up, cards. 400,000, predominantly blue. A few reds in there as well. Actually, using a few assumptions, C should do it based on some average market assumptions. That's 340,000 of capital required to cover that £15,000 a year shortfall. Again, my concern is that individuals don't know this until it's too late. Trying to save that amount of money, and don't forget this was obviously per couple, so this may well be 2 pension pots, but actually trying to understand this early enough to actually make the difference, that's a big worry, and we see that an awful lot.
So what's the solution? So in a perfect world, again, best practice, you'll see this all the way through. We're going to look at what best practice is and what at minimum really should be done. Best practice is to start pension engagement for all your people as soon as possible, so that they actually do start thinking about these sorts of things all the way through their career. And we know now that it's not just pensions, it's about saving for retirement. And pensions, while still a massive building block of that, it's not only pension that's going to be part of that. If nothing else, in that 5-year path pre-retirement, people are going to need a lot more help now. We've got pension freedoms, we've got choice at retirement. People need to understand what that means. I suspect quite a lot of you will have still either 3 default funds still pointing towards annuity, drawdown or cash, or some combination of that. And that will probably start lifestyling somewhere around 10 years out, 8 years out, 7 years out, etc. And people need to understand that. They need to understand the implications. So really helping with that from a financial education perspective. And then in that 12-month period pre-retirement, it's about giving them that support so they can take advice. They can take advice that's suitable to their circumstances. They can look at getting their house in order before they do that. And obviously going all the way back to that 10 years, there's plenty of things people can do still at 10 years out from retirement that can put them in a much better position at the point of retirement. We would always say for something as important as a retirement decision, it's essential that people take advice prior to making those decisions. It's becoming more normal for employers to look at that aspect of advice sitting alongside education these days, but we say for the retirement decision, it's an essential thing. At minimum, we'd say you should make sure that you've got some sort of retirement income modeler available for people to use, pension saver modeler, retirement saver modeler. You should at minimum communicate pension freedoms and what that means so that your staff understand it. Top tips on where to find the best advice. I know people don't always like recommending advisors particularly, or they may not have an advisor panel. But just telling them go to unbiased.com or go and look on a comparison website is giving them no help at all. They need to know that advisors who have got specialisms perhaps in DB transfers, we'll look at that in a second. Top tips on how to avoid fraud. Only allowing transfers to suitable investment products or investment product providers, and checking individuals whether they have received advice. So those are the areas absolutely that we would say are a bare minimum. So let's look at stage 2. Stage 2 is looking at DB transfers.
Thank you, Jeanette. I think DB transfers has obviously been, there's no day passes without some further information about this. And I just wanted to share with you an email that I received only a handful of weeks ago from an individual. And I appreciate that you won't be able to see it on the screen, but I just wanted to point out one key area that I wanted to, one key bit on here. And my concern here is that the decision has already been made to transfer this individual's pension before any formal advice, consideration has actually taken place there. And that's really quite dangerous. So what are people trying to do? What are people trying to decide? Again, you've got some A's and B's on you. We've got a situation here. At the point of retirement, we've got option A, £7,981 of income a year, or a transfer value of £175,000. What route would you take? I'm glad I didn't see as many cards go up as quickly as I did in previous ones, because actually we can't answer that based on this information there. So sorry to trick you out, but some of you were a little bit more dubious about putting your hand up there. We can't answer that with this information, but you'll be amazed of the number of people sat around their desks trying to do such exercise before any formal advice or indeed guidance has actually been given. And that really worries me.
So what's the solution there? We start with education. So if you have got an exercise that's going on, or even if you haven't, if you get an increasing number of DB transfer requests into your teams, have a look at telling them what DB transfers means, what this is all about, the key areas to think about, who this should never be for and who this might be for. They're the only two categories that exist in DB transfer. There's the nevers and the maybes, until such point as they actually sit down and speak to an advisor. Access to a selected DB pension transfer specialist advice service. But if you're not doing that, at very minimum, top tips on where to find suitable advice. Pension transfer advice is incredibly specialist. There's a lot of requirements sitting next to it. Sending people to, again, unbiased.com or a comparison website is like feeding them to the lions. It shouldn't be done. You've got to give them some help in going to try and find the place that's going to give them suitable advice. Top tips on how to avoid fraud. Only allowing transfers, again, to suitable products. Check individuals have received advice, and actually have a strategy yourself as a firm. What are your integrity values on this? So what's your position if you know the advice was a no? Are you happy to process an insistent transfer? And that's something that you've got to think about. So as a firm, have a view on what you're happy to accept. The next area, the third area, is looking at lifetime and annual allowances. So, I guess, have you communicated the reduced limits? Probably most of you in the room would say, tick, yeah, done that. Have you reduced annual contributions to 10,000 for those that you know are impacted, or for high-risk groups? You know, some of you might have done that, some of you may be considering it. Or have you provided a cash alternative? Maybe. If you've done those three things, do you think that's the solution? Just yes, no? Shout out. I'm seeing some heads shaking. Yeah. Far from it, really, in our view. So absolutely far from it, and we'll show you why.
Thanks, Jeanette. I think in terms of lifetime allowance, certainly in terms of when we're looking at final salary schemes, too many people can concentrate on the 55% tax charge but forget the 45% benefit. Certainly looking at both options is really, really important on there. But annual allowance, that really concerns me at the moment. So I thought I'd illustrate this by a bit of a case study, and we've got Emma and James up here. Two individuals, Emma earning £100,000 a year, 20% in total going into her pension. Over a 10-year period, assuming some growth, she could accumulate just under £300,000 in her pension pot during that period of time. James, however, high earner, restricted pension contributions to £10,000 a year based on previous communications that he's had over the last 12, 18 months or so. Look at the difference in the pension pot between those two individuals. Is that a message? Is that really understood? Potentially, James has got a pension pot that's 42% less than what Emma has, despite his earnings. Now, we could develop this a bit further and assume that James received a £10,000 pension supplement. Let's assume some tax and national insurance. What is he actually doing, though, with that benefit? Can't pay into his pension anymore, is receiving a cash supplement, which is good to see, but what is he actually doing? What would you do in the room? What do you think?
And that's every year, remember, so...
Year on year. I'm absolutely amazed. No one would go on holiday. Come on, let's be honest. No one would go on holiday? Thanks very much over there, okay? It's amazing how, let's face it, what lands into your bank account soon disappears. And there's a problem. If we're really honest with ourselves, there's a discipline problem, isn't there, in a lot of cases. Real life crops up, and let's face it, going out to see the Lions at the weekend might well be on top of some people's priorities. So what does he do? Well, clearly, if he does go on holiday, the money's gone. That's a year's pension contributions disappeared. Perhaps you overpay the mortgage. Using an average mortgage, average duration, might reduce that by about 8 years. That could be a very good option for that individual. Certainly if we're looking at saving either in cash or some form of investment portfolio, C or D, capital is going to be saved, but nowhere near the amount that would have been saved within that pension. And that's worrying, particularly because we've got Emma, who was earning about half of what James was earning, and pension pot is going to be significantly greater. We could still see about £100,000 shortfall in that individual's retirement planning. And it's really shocking to see individuals who believe they've done the right thing by reducing their pension contributions to £10,000 a year and forget that that's only step one, the fact that a major retirement savings tool has obviously disappeared.
So what do you do about it? How do you help those people? As Simon said, it's a starting point to make sure that they're not paying that tax. But they've got to do something instead. And as we saw in the room, knowing what to do instead is really hard. But actually, they've got to know about that. They've got to know what the choices are, and how do they go and find those choices. So we start with education. This is an annual problem. People are going to be moving into that zone every single year. So this is something you need to be doing with them every single year for those potentially affected, for those approaching those limits, or potentially for all employees. Some firms we work with choose that route, all employees, because we don't know what they're doing outside of our business. The education needs to not only address the limits and the issues and show them examples and where they sit on that, they've got to look at the alternative investments to supplement what they're not getting through their pension. They've got to find a way to make up that 171,000, and that's really hard. And more of those people may need that access to one-to-one advice. Okay? The final area we're going to look at is managing debt. Unsurprisingly, debt is often made out as a villain, but sometimes debt is not a villain. There's good debt and there's bad debt. Bad debt is where people really can't cope. It's beyond their payment scheme. It's from the wrong provider. It's huge high interest rates, etc. Good debt is part of a general financial plan. A mortgage is a sensible way to buy a house or to afford a house. Knowing the difference between that, not villainising debt, managing debt and knowing where to go to get help is key in this. Crippling debt, people who are in that situation need help and they need it immediately. A lot of you will have employee assistance programs in place. A lot of those will have debt counselling services or access to charities or access to bankruptcy proceedings for some cases for some people. Make sure people know how to use them and make sure about that. But debt as part of normal life, it has to start with education. Where do people go to find it? How much should they put themselves in? How much leverage, personal leverage, should they have? What's enough and what's too much? Where do they go to get it? Where are the safe places to go? Where are the best places to go? How do they find them? How do they then review that on an ongoing basis? Everything in the financial planning spectrum is not about do it once and then put it away and forget about it. It's about continual review. So they need help with that and they need help and understanding. In summary, financial well-being for us can be summed up in 7 steps, and this is financial well-being. It can be looked at from a company perspective and from an individual perspective. Have a strategy, have a plan. Communicate that to your staff. Tell them this is there to help their financial well-being, and these are the building blocks that you have to help them do that. Ideally, have a program that includes all your workers. If not, start with the key risks, then add the biggest impact, and then add everybody else. Measure the starting point so that actually you can show improvement over time. That can only be beneficial for your business in terms of your return on investment, but also for individuals because that helps with engagement, and refine the plan over time. Thank you.